Good morning, everyone. Welcome to the Vetiva breakfast meeting. Today I'll be going over Flour Mills' FY21 performance. Following that, we'll be hearing from our global equities desk on the equity markets and fixed income desk on the fixed income and currencies markets. Following that, we'll be getting headlines across Africa from our media partners at Frontier Africa Reports. During the course of this session, please feel free to send in questions using the comments, any of the comment sections available on Zoom or Facebook. If you prefer, you may raise your hand to speak. However, we'll be having a Q&A session after the meeting, after all speakers are done, and where would allow you to speak. Would like everyone to know that this meeting is being recorded and may be shared with third-party listeners. So very quickly, I'll be starting with the presentation on Flour Mills. So Flour Mills reported its FY21 results, which showed that it had a good year. I mean, we had expected this from when we saw its 9-month 21 results, where we saw that the 9-month 21 performance outpaced the FY20 performance, both in terms of top line and bottom line. However, the actual performance still outpaced our expectations by 4%, at least in terms of revenue, as the company reported a 34% increase in 34% year-on-year increase in revenue to about 771 billion naira. Looking through the segmental growth drivers, we saw that growth came from the food, majorly came from the food and agro-allied segments, although the sugar segment as well showed considerable growth. So for the food segment, we saw 33% growth. For the agro-allied segment, we also saw about 33% growth, while the sugar segment grew about 27% year-on-year. First, the overarching theme, which was also restated by management, was that revenue was driven by significant volume growth. So aside its B2C marketing strategy, which it has decided to focus more on, the company has also focused a lot more on the value segment of the consumer goods space, where it has introduced a lot of value offerings, at least over the past 1.5 years. So for the food segment, we know that in its pasta segment, it has introduced 2 new variants. Also in its bowl food segment, it introduced at least 3 new variants into the market. So we think that is what has supported volumes over the past 1.5 years. And it's very interesting to note, especially for the pasta volumes, because we had expected that now that the borders have been reopened, we'll see some volume dampening in terms of pasta. But those volumes, according to the company, have continued to grow by about 23% that we can see. So our outlook for revenue is that food will continue to drive growth. We still expect growth from the agro-allied segment. However, we note that most of the growth that has come through from that segment has been on the back of a low base effect from the previous year. So we know that Flour Mills had recently undergone a restructuring of its operations. And so the agro-allied business came from a loss-making position to about a 10 billion naira profit position in FY21. The reason why we expect food to be the major driver is that food continues to remain a defensive segment, and with the company's strategic positioning in the value segment, we expect that to stable volumes over the next year. In terms of the agro-allied segment, while we expect that to still grow, we expect most of the growth to come from the edible oil segment, given that and also the fertilizer segment. Although for the fertilizer segment, we know that Dangote has also recently commissioned a 3 million metric ton fertilizer plant. Although the company only produces urea fertilizer, which is quite different from what flour mills produces. Although flour mills also has a urea product, it mostly produces NPK fertilizer, which we think will differentiate itself in the fertilizer market. So in terms of cost, we saw cost grow 31% year on year to about 664 billion naira. But despite this, gross profit still grew about 62% to 107 billion naira, which improved margins from 11% to 14%. Our outlook for cost is driven by expected FX challenges and possible global supply volatilities. In terms of the wheat and sugar ban, we do not exactly see that panning out. This is because we still see there's still a severe deficit in terms of local production of wheat and sugar compared to our consumption levels. And if producers are then forced to, we believe that if producers are then forced to source for FX in the parallel markets, it would heighten food insecurity and push up inflation, which the CBN is trying to avoid. So we do not see that panning out. However, we note that if that happens, it would strain our flour mills' operations significantly, because at the moment, the company gains about 62% from its food segment, 62% of its revenue from its food segment, and 85% of its food products are dependent on wheat. Also, for its sugar segment, it contributes about 15% to its revenue. So we can see how, if that happens, it would really disrupt their operations and revenue forecasts. However, since we do not see that happening, we expect that cost to grow by just 13% to about 750 billion in FY22. In terms of margins, because the company has decided to focus more on value segments, we do not see margins improving significantly. In fact, in the next year, we expect that margins will shrink by 1% to 13% from its current position of 14%. One other thing that dampened the company's performance, even though we saw that gross profits increased significantly, we saw that the company recognized a 15 billion naira foreign exchange loss. As at 9 months, we saw that it was 12 billion naira, so we had been expecting this. And the company added about 3 billion naira in foreign exchange losses. But this was slightly mitigated by a write back of about 2 billion on its receivables impairments. So moving on to finance costs, we saw that the company's finance expense reduced by 7% year on year, and this was despite a 30 billion increase in debt balances. So we know that last year, flour mills came into the bond market, and issued a 30 billion naira bond at about 6% levels. So we think because it had been able to take advantage of the low rates at that time, interest expenses they don't move as much. However, our outlook for finance costs is that finance costs will increase by about 29% year on year in FY22. This is driven by an expectation that flour mills will come into the debt markets in the next year. And this is because we expect them to make significant capex investments in the next year. So around last month, yes, June or May, we saw that flour mills put out a letter to say that they were going to be purchasing or acquiring about 20,000 hectares of land so that they could further their sugar backward integration program. This project will include a mill similar to what they currently have now, and we think it would, include a very healthy capex investment. Furthermore, the company stated during the call they had yesterday that they would be, they were very pleased with the performance of their agro-allied segment, and they'll be furthering investments in that segment, in that region. And so we thought that we expect the company's debt balances to increase, and given the interest rates regime we're currently seeing, we expect finance costs to improve or to increase in the next year. So moving on to PAT, we saw that PAT grew by 1.2 times, that's 124% to 24 billion naira. And the company has proposed a dividend of 1.65 naira per share, which is 18% more than the dividend that they proposed last year. I think it's about 1.4, 1.40 naira thereabouts. So the 1.65 naira per share that they have declared or proposed would then yields a dividend yield of about 5.7%. So our outlook for this is that PAT will grow by 16% year on year based on all our other assumptions. This will come in at 28 billion naira. So with this, we have a target price of 38 naira 40 kobo for flour mills, and we rate the stock a buy. I think that concludes my presentation on flour mills. Next, we'll be hearing from Seun on equities. Good morning, Seun.
Good morning, Chima, and good morning, everyone. So we start off a roundup of the markets across West Africa in Ghana. In Ghana, the index consolidated on previous day's gain as it closed 32 basis points higher to improve the year-to-date return of the Ghana market to 36.6%. Activity level declined significantly in the session as there were no large trades in any of the large cap names compared to the previous session. EcoBank was the most active counter as it closed 20% higher to end as the best performing counter, as well as the highest traded stock in the market. Aside the EcoBank trade, it was slightly quiet. Going into the last trade, so going into today, which is the last trading day of the week, we expect to see trades around key stocks like MTN, Cowbank, Society General, while activity level remains flat going into today as well as into the rest of the month. So quickly we'll move to BRVM, which unlike in Ghana, the index closed the first trading day of the month lower by 49 basis points. For the second consecutive day, we saw Uniwax and Seco led the gainers chart as investors took profit on Vivo Energy that has seen decent appreciation. Turnover declined in the session. However, we had more gainers compared to losers that we saw on the day. So going into today, we expect improved market activity as investors cherry pick on decent names like Sictal and Air Liquid specifically, while also selling off some that have seen 2 to 3 days 3 days of gain. So with that, we expect profit taking in Uniwax, having gained in the last couple of sessions. So basically, we expect activity level to remain flat in that market. Then finally moving to Nigeria, the new month started on a marginally negative note with a 2 basis point downward close, quite marginal there. Profit taking in the likes of GT Holding, Oando, as well as Dangote Sugar, ensure the market closed slightly lower. Just as expected, activity level also declined as market could not sustain previous day's level. Though we saw a large 31 million cross in GT Holdings, which accounted for about 54% of the day's turnover. So I think just earlier in the morning, earlier in the trading session, we saw about 31 million cross of GT, and from fillers in the market, they were done by local investors and not foreign investors. So moving on to sectoral performance, this was largely positive, with a 43 basis point gain in the banks leading that pack there. My side days market was mainly quiet. So for our expectation for today, we expect a positive week on week close for the index, as we do not expect any major downward close in any of the large cap names. We also expect investors to continue to stay neutral, as a few local investors are expected to cherry pick names with potential to outperform consensus estimates in Q2 earnings release. So those are the things we'll be looking out for today, and that's our expectation for the Nigerian market. Thank you very much.
Thank you very much, Sean. Next up is Omarige, and he'll be taking us through fixed income and currencies. Good morning, Omarige.
Good morning, Chima. Good morning, everybody. System liquidity for yesterday declined to open at about 26.59 billion positive, coming from the 201 billion positive that was recorded on Wednesday. Despite the decline in system liquidity yesterday, OBB and overnight rate maintained to trade at 11.5 and 12% respectively. We expect interbank rate to trade at similar levels today in the absence of any major change to system liquidity. The parallel market remains stable at 503 naira to $1 yesterday, while the earning window traded at 420.95 naira to $1, closing at 410.7 naira to $1, which is a 80 kobo appreciation from where it closed on Wednesday, despite the significant decline in an industry turnover, as it declined by over 61.7% to close at $61 million yesterday from the $160.12 million that was recorded on Wednesday. The Brent crude recorded a gain of 1.39% to close at $75.63 per barrel yesterday, while the WTI crude also jumped by about 2.4% to close at $75.23 per barrel yesterday. As earlier said yesterday, OPEC planned to hold a meeting yesterday to basically determine their next action regarding supply. But the meeting was put on hold because UAE frowned at the idea of OPEC boosting supply by about 2 million per barrel for the next half of the year. So the recent uptick in price that we have seen in crude oil prices basically has been on the back of the reduced supply, as OPEC has been cutting supply by about $2.1 million per barrel. So that has significantly strengthened the price, coupled with the increasing global demand that we have also recorded. So like I already said, the meeting has been delayed. So they plan to hold the meeting again today. So bring feedback on the outcome of the meeting on Monday. So the T-bills market traded on a relatively active note yesterday, as some players tried to feed their loss bid at the auction in the secondary market, while we also saw some other players coming to the market to try to book quick wins on their auction winnings. We saw a moderation in rate on the 1-year paper as the market reacted to the rate cut at the last NTB auction. The offer on the 1-year paper dipped by about 50 basis points to settle around 8.5% levels, while the bids were hovering around 9% levels. Overall, most of the trades that were consummated in yesterday's trading section was on the newly issued 1-year paper. That's the June 30th, 2022 maturity. In the OMO segment, it was a different story. The market was relatively calm. We saw FAS on the long end of the benchmark curve, especially on the March 2022 papers. Trades also consummated on that space were majorly on the long end. In the bonds market, it was a similar story. The bulls continued to dominate the market as players continued to trade sentiment around the expected July inflows, with some short players coming into the market to try to cover their short positions. The most traded maturities in yesterday's trading session were the auction papers, that's the 2027, 2035, and the 2050 maturity, We also saw some buy-side interest on the 2037 and the 2049 maturity. And that was because some short sellers were trying to cover their short positions. We got feelers in the market yesterday that the DMO plans to issue 2028 and 2037 maturity in the next auction. So this news caused a slight sell-off on those maturities in the secondary market as players try to offload their current holdings in those securities with the hope of getting them at higher levels at the next auction. Overall, it was an active trading session yesterday. The local Eurobond market traded on a very mixed note yesterday. The short end of the curve was bullish, while the long end traded on a bearish note. The Nigeria 2025 lost about 0.25 basis points day on day, but the 2047 and the 2049 gained about 1.25 basis points. In the corporate space, we saw buy-side interest on the Access Bank 2021, Eco Bank 2024, and the First Bank 2025, with average rate decreasing by 0.58 basis point across those three maturities. Our outlook for today basically is that the fixed income will trade on a very active note to close the week with a slightly bullish undertone as market continue to react to the rate cut at the auction, and also trade sentiments around the expected inflows this month. The first inflow that will come in this month will be in July 12th, when we receive about 104 billion promissory note maturity. And we believe that we also spur moderation in rates in the fixed income market. That will be all for fixed income. Thank you.
Thank you very much for your analysis, Orege. Next, we'll be hearing from Temple Ashaju. He'll be taking us through updates across African markets.
Yes, good morning, Chima. Actually, Bosin Omofaye here. I hope you can hear me. Good morning, everyone.
Good morning, Bosin. We can hear you.
Good morning. Thank you very much. Actually, we're running through a couple of macroeconomic data from a number of frontier African economies. Kenya inflation came in 6.32 for the month of June yesterday, crossing from 5.87% in the month of May. Uganda's inflation also head to 2%. We're seeing inflation pressures from these economies, by the way, on the back of a rise in prices, the whole knock-on effect of the coronavirus pandemic. Not particularly good news for South Africa's manufacturing PMI, which retraced slightly to 57.4 last month, just as we're seeing the announcement of level 4 virus lockdown for the Africa's most advanced economy. Whether this will continue to go down in the new month we are is anyone's guess. But the business confidence data that came in a few days ago or late last week showed that confidence is waning a little bit in the industry, and the new virus lockdown, stricter restrictions on bars, on alcohol, on hotel tourism, casinos, and others will likely take effect moving forward. Zimbabwe's central bank yesterday held policy rate at 40%, inflation at 106.6% at the last month of May. They're quite optimistic they'll be able to take this all the way down to double digits anytime soon. But the central bank is holding rate at least at 40%, trying to manage the level of liquidity that is coming into this very big country, important economy in South Africa, or Southern African space, by the way, which is Zimbabwe. Egypt is expected to grow economically wise 4.2% this year, 5.2% better in 2022. That's according to the Economic Bank for Reconstruction and Development. In the meantime, the country's current account deficit doubled to $5.7 billion in third quarter of its full year 2020-2021. Foreign investors remain net buyers of financial assets in Egypt, again, because of the currency and the carry trade opportunities that this free float currency actually provides. Two banks in Ghana got a review to a negative in terms of outlook from Fitch Ratings that came in also overnight. Then we have the Africa renewable energy fund, which is the private equity fund, of which AFDB is midwifing on behalf of countries who need these funds to move on clean energy. So the first financial close of 130 million euros had been done through 2 investors. They're looking forward to other investors. This will help the AFDB help countries within the continent be able to leverage necessary funding for renewable energy, solar, wind, hydro, and others. That's quite some news we're tracking as well. Moving into the weekend, the biggest news anyone should keep an eye on is the warning that Africa is going to face its worst week in coronavirus pandemic. Is good for everyone to keep safe. That is very important. The new variant is getting a whole lot worrisome, and the alarm is being raised that everyone should keep safe and keep all the health protocols as you can imagine. The news is on the street. So whether that will affect us in Nigeria here is anyone's guess, but for now, it's good for everyone to just keep very safe. Thank you very much and have a great weekend, everyone. Thank you very much.
Thank you very much, Boason. We have come to the Q&A segment of the session. If you have any questions, you may use any of the chat boxes available on Zoom or Facebook, or if you have a question for us, you may raise your hand and we'll call upon you to speak. Good morning, Ifeanyi. Please go ahead with your question.
Yes, good morning. Yes, thank you very much for today's presentation, especially on the flour mills. I saw very good performance. I even looked at it yesterday, and that was confirmed by what you presented this morning. But what I need explanation more for is the fact that with all this stellar performance by flour mills, the dividend yield is just 5%, very small. Why is their dividend policy different from like a peer or a peer company like Nestle that pays almost everything out as a dividend and makes their investors happy? But with all the amount of money they made, profit they made, dividend yield was very, very small. Any explanation as to why? Thank you.
Thank you, Ifeanyi, for the question. So according to management, they are planning to prioritize CAPEX investments in the next year. So that is why they proposed, well, they didn't propose lower dividends, they proposed an 18% increase in dividend payouts. But as to your question on dividend yield, I'm assuming that is why their dividend yield is quite low. The company stated that they'll be prioritizing investments in CAPEX, especially in the agro-allied segment, because they're happy with performance in that segment. So I think that's where the bulk of their earnings will be going to. I hope that answered your question, Ifeanyi. Okay, if you have any other question, please raise your hand or send your questions in the comment section. All right, I see that we have no other question. Oh. Okay, do we expect similar results for other players in the industry? Well, for the sugar players, for Dangote Sugar is also one company that has recorded very impressive performance, top line and bottom line, over the past year. We expect to see that continue because the company is a market leader in that segment. That's about it. Also for honey flour, which is also a food producer in the segment, we have seen positive results and we expect that to continue. Basically because the food sector remains defensive. So even as consumers continue to see their purchasing power deteriorate, people still have to spend on food. So we expect similar results for the food players and sugar players, sugar producers in the sector, in the industry. I think that about does it for the questions. We thank everyone for joining us today. As Boasin said earlier, we encourage everyone to continue to prioritize safety measures and to continue to stay safe. We wish you all a very productive day and weekend ahead, and we hope to see you on Monday at the same time. Thank you so much for joining. Good morning.